So the topic du jour are the 8 tax secrets your CPA or tax professional might be missing. And by the way, this is geared for my high earning W-2s. There are a few business owners in here. I see you. I know you. Thank you for coming. We will be having another webinar around that, but a lot of the things you'll be hearing today are still relevant for you. But the reality is, for our W-2 people, there just aren't a lot of ways to get tax deductions. But we're going to break them down today. And I have 2 amazing panelists that I've gotten to know and do business with continually over time that are here today to get everything rolling with us. So to get us kicked off, I'm your hostess with the mostest. My name is Meredith Moore. I own Artisan Financial Strategies. I have been in the financial advisory world. I will hit 26 years this year in May, big year. And we own a practice that is very holistic. The reality is most people that come to us as a new client, they have an investment person, they have an insurance professional, they have a tax professional. If I'm really lucky, they have a trust and estate attorney, but nobody's talking and balls are getting dropped. So we help coordinate and integrate all those things together to build holistic plans. Next, let me introduce my tax BFF, Mercedes. Please tell us a little bit about yourself.
Sure, absolutely. My name is Mercedes Pasqualetti. I am the president and managing partner for HLM Financial Group. The firm was started in 1986. I'm an IRS enrolled agent, which means I can practice all the way up to the court level. From there, I have to turn it over to a tax attorney. I have a master's degree in small business and entrepreneurship, and have been doing this for a very long time. So I'm excited to be here and share this information with you all.
Great. And David, I'm going to do a preliminary. We manage a lot of investments for clients, and David is one of our portfolio managers. We use the firm quite a bit to help us once we've decided from a planning standpoint what the client needs. We need our analysts to really jump in and support us. So we're on the phone with David and his team quite a bit. So with that, David, maybe you could explain who you are and what you're about.
Yeah, thank you, Meredith, and thanks for having me here today. So my name's David Rosenblum. I'm a senior portfolio manager with Brinker Capital Investments. We're a firm that has been managing assets for over 35 years now, since 1987. And Meredith mentioned holistic planning. That's what we have top of mind with. We do the investment management and work hand in hand with advisors like Meredith to help clients reach their goals and objectives through prudent asset management. I've been in the industry over 13 years in roles from investment sales to corporate finance to where I sit today as a portfolio manager. To start off earlier, I'm up in New Jersey. Taxes are not my friend. I'm always looking for ways to save. So I'm going to be taking some notes for Mercedes today that maybe I can apply in my not so tax friendly state of NJ.
Wonderful. MJ. And so please, everybody, David's going to be actually providing some really good information too on markets. Trump 2.0 is creating a different landscape in terms of investing, but back to holistic planning. Tax diversification is a big component as well as investments, and we're going to be addressing both today. So to get us kicked off, we're going to hit some of these top tactics to reduce taxes. We're on simple, actionable strategies today. So immediately, if you're taking notes, you know some things to do where you can go talk to your tax professional or your advisor about what you need to do. Now, this one may be the first one I think is more obvious, but Mercedes, you want to kick us off here?
Sure. So for those of you that are high earners and you have access to a 401k through your employer, one of the best ways to reduce your taxable income is max fund your 401k with pre-tax deductions. A lot of you may have a Roth option within that, but we have to talk about strategies surrounding which one to pick. But if you do the pre-tax option, it will reduce your taxable income. A lot of times your employer has a match, and so we want to minimally be getting at least the match. So if they have a 4% requirement, we want you to at least match that. But ideally, we would love for you to be max funding that every year. The sooner you start doing that, The longer that has to compound, the better off you're going to be in retirement. The other option is to consider for after-tax contributions for a mega backdoor Roth conversion, and that would be a strategy that we would employ, and Meredith would help you with that. So you want to touch on that a little bit, Meredith?
Yeah, what's really interesting is I think, first of all, it's worth noting how the contribution limit went up. So for those of you that already went through open enrollment in November, just please note you select a percentage, but you might want to make sure that you're going to max out based upon that percentage, given the dollar amount has gone up. And especially for those of you that, like me, had a big birthday last year. So yay, I get catch-up contributions now. Make sure that you're taking advantage of that. But the mega backdoor Roth is fairly new, and I've seen it if you work for a fortune company. I've seen that being available at those companies. Not every company has a mega backdoor Roth option, but in a perfect world, you can do that or talk to your advisor professional that knows a lot around tax planning strategies.
Yeah, and one other thing about that is that there is a super catch up this year. So if you're between the ages of 60 and 63, specifically in 2025, the catch up went from 7,500 to 11,250. So if you have the ability and household cash flow to max fund that, if you're in that tax bracket, it's a good way to chunk down on your taxable income and also get a little bit more in there for 2025.
Thank you on that. Yeah, I had forgotten about that one. Things are changing so rapidly. I feel like the tax laws around this stuff were the same for so many years with minor increases in contribution limits, and there have been so many changes. So I think this also begs the importance of doing an annual review with your financial advisor and why you want to be having a tax strategy engagement with your tax professional. Most people I know come to me, they're like, hey, they pay for tax preparation, but there's no tax optimization. There's no proactivity. There's no strategy. And that's where I know Mercedes and I do a lot of collaboration together. So Roth IRA and conversions, Ms. Pasqualetti, what you got?
Yes, if you don't have any rollover IRA money, you don't have any money sitting in a separate IRA that you've had for a while, if you're above the income limit to fund a Roth, there is an opportunity to do what's called a backdoor. And so that would be contributing to a non-deductible traditional IRA and then immediately rolling it over to a Roth. Seems ridiculous to have to take two steps to ultimately accomplish the same thing, but there is a loophole in the code. So if you don't, like I said, if you don't have other IRA money, and the reason for that is if you do, then a pro rata share of that rollover from the IRA to the Roth becomes taxable and not quite as favorable. And the idea with this is that we can get the money into the Roth. We don't have the same RMD requirement. You don't pay tax on the earnings when you take it out because it's already been taxed. And it gives you a lot more options in retirement if we have a taxable and a non-taxable bucket to pull from to manage our strategy better.
And I think to that point, we all know, maybe we all don't, but the Holy Grail is tax-free. And if Roth is tax-free, exactly what Mercedes said, I really want to really put a point on this, is with all your pre-tax IRAs, you're forced to take the money out and pay the taxes, which can put you in a higher tax bracket later. And the Roth, you're not forced to take the money out. And if you did, it is tax-free. And so I think for our high earners that have done a good job saving, the benefit of not having, she used the term RMD, that stands for required minimum distribution, meaning being forced to take it out. Not being forced to take it out is as big as of a benefit, in my opinion, as the tax-free nature of it. And so I want to be really clear. A lot of people ask me, do I Roth or do I not Roth? And the answer is, when are you going to be in a higher tax bracket, now or later? Which also leads to pontificating around where tax rates going. So please think about that. And in that vein, we're always looking at what we call tax bracket capacity. I know Mercedes looks at that even more than we do, but we always analyze it when we're looking at a 1040. Because when we do a conversion, you're going to pay tax on that money. And that's fine to get it tax-free, but it's important. We typically don't want to jump brackets. And I think that's your strategy as well, Mercedes. Is that right?
It is, and also there's a timing thing. So a lot of times if you're in your high earning years, we really need the pre-tax benefit of it. And then there's this kind of sweet spot in the year of retirement or the year 1 or 2 before you start drawing or have to take your RMDs and you start taking your Social Security where you're in a super low tax bracket. And then we really want to try and convert some of that pre-tax money to Roth.
Absolutely. And we do have a question. I can actually see it, David, so I know you're on it. What's the difference between a Roth and a catch-up from an investment perspective? Do you need to have both, or the catch-up will be sufficient? I think the answer to that is you start with the base contribution, and if you've met that, then the catch-up comes into play. So given, what's the 2025 base contribution limit again? I just found on the previous slide, 23 or
3.5.
2025? Okay,
Mhm.
23.5 plus the catch up, and then the extra piece that Mercedes talked about. What was it, age 60 to 63?
Yeah,
You said?
the super catch up. Yeah. So if you're not already funding the initial portion, we would want to get that maxed out and then you want to fund your catch up. And the catch up is only if you're 50 or older. So if you're under that age bracket, you don't have access to do the catch up. But if you're over that bracket, you do. It gives you the ability to get more in there pre-tax later on in life so that we have a pile of money that's extra to grow.
So when I get asked, do I Roth or do I not Roth? I'm always looking, I take a little bit different perspective than Mercedes and a tax professional might, because I'm looking at 30 years from now, based upon how well they've saved. Are we going to be in a higher tax bracket or are we not? I find that most financial pundits always tell people you're in a lower tax bracket in retirement. That just simply has not been the case for many of my clients who have been good savers. And so we have to approach the strategy a little different. So I would really look at how much you've saved, and realistically, are you going to own businesses? Do you have a lot in retirement accounts to where you might be in a higher tax bracket? And God knows where tax rates are going. I'm sure that's a whole nother webinar to pontificate on the state of politics right now. So next, tax advantage accounts.
Okay, so the health savings account is a really great avenue for people who don't necessarily have to use their health insurance a bunch during the year. You do have to have an HSA qualified health insurance plan. Usually those have HSA somewhere in the name of your policy. Okay, and so what happens with those policies is you have to pay the full deductible before the percentage that the health insurance is going to pay kicks in. That's great if you're healthy, right? And so the offset to that is to do a health savings account. A lot of people have a flexible spending account. The limit on those are 2,500. They're a use it or lose it type of account. So if you're not going to use it, the HSA would be a better way to go, because what happens is you can contribute to your HSA. You don't have to use it. It rolls over. Even if you leave your employer, it's your money. And so that can continue to grow. And a lot of the health savings account platforms have an opportunity to invest. So usually once you hit about 5,000 in that account, you can put it into ETFs or funds or money market, depending on what the options are in that platform. The awesome thing about the HSA is then in retirement, if you need in-home care, you need out-of-pocket for surgeries, you need prescriptions, you cannot use it for health insurance premiums right now, but you can use it for all other qualified medical expenses. And so if you invest that money, you don't strip it out every year and you've invested it, then that also is another tax-free avenue that you can use down the road for tax planning and strategy, and also to not increase your taxable rate in retirement.
Yeah, I always talk about there's rare things where you get a triple tax advantage. And so we simply get it here. The other thing, and it used to be that we could run long-term care premiums for those that have long-term care insurance as an asset protection play. You could run it through the HSA, and business owners get to deduct that. But again, if you're a high earning W-2, you're just not getting the deductions without owning a business. And so is that still the case where we can run our long-term care premium to get the eligible expense through the HSA and the long-term care insurance,
You
Mercedes?
can. Yeah.
Okay, excellent. W-2s, please do that. Okay, and you touched on FSA. Want to speak a little bit more there?
Sure. So the FSA is, again, a use it or lose it. It is a pre-tax, so it's going to reduce your taxable income. But if you don't use it all, whatever's left in that account goes back to your employer. So I would say if you have access to this and you know you're going to use it, go ahead and max fund it. If you're not, only fund what you think you're going to use, because we don't want it going back to the employer.
Yep, exactly. I got some thoughts here, but I'm gonna let you jump.
Okay.
Education.
Sure. So the 529 plan is a college savings plan. Each state typically has their own, as well as a lot of the brokerage houses, John Hancock, Fidelity. They also have 529. The earlier you start contributing, the more benefit that you're going to get. Typically, the investments in the 529 account, and Meredith and David maybe can speak to this a little bit, tend to be a little bit more conservative based on a timeline for going to school. So depending on how that product is performing, there may be better opportunities for growth. But the nice thing about the 529 is if it's in a state plan, for example, in the state of Georgia, you can contribute $8,000 per individual per year, and that would reduce your taxable income at the state level. Now, state of Georgia is 5.75, so on 8,000, it's not a huge windfall. But if you couple that with the potential growth, then when you take it out for qualified educational expenses, you're not paying any tax on the growth. One of the newer provisions is that you can now use up to $10,000 per year for K through 12. I get a lot of times people are like, if I open a Georgia plan, do I have to go to a Georgia school? The answer to that is no. It's just a plan sponsored by Georgia. So if you live in Virginia, they have one, we have one. So it just depends if you want to get the state tax benefit or if you prefer something that has a little bit more aggressive growth.
I could speak to that a little bit if I could real quick. So I think what Mercedes is also talking about with the fund options inside of 529s, a lot of them are what we call age-based. So the thinking is, it's also called like a glide path. The closer you get to when they graduate, the more conservative it gets, which is not a bad thing because that allocation is managed for you. So I like age-based plans. And again, the tax-free nature of that growth is huge. And I know there's a couple of people on here that have grandkids. So doing a lot of gifting, you could own the plan and then the beneficiary would be the grandkid. And to Mercedes' points, I've got clients in 30 other states. I know in Maryland, we're dealing with this right now. The state deduction's only $2,500. So Georgia has decent tax benefits. And with that $8,000 contribution, that's just basic planning. Everybody should be doing that just simply to get that state tax deduction, I think.
Yeah.
Meredith,
And the other
of grandkids, is there a tax benefit as a grandparent to set up and contribute? It's a question from the audience.
And yeah, absolutely. So 529 contributions are not tax deductible. The contribution is not. The advantage is, and again, Mercedes, please feel free to jump in. I feel like it's a sort of value purpose built gift where you don't know, but it's used for education. If you took money out early, I feel like the penalty's not terribly punitive. It's you pay tax on the gains plus a 10% penalty on the gains. So
Let
it's
me
not
just jump in there real quick, Meredith, because if a
Please.
grandparent is in the state of Georgia and they're the account owner and the grandkid is the beneficiary, they would get to reduce their income in Georgia by the $8,000.
Got it. Thank you. Sorry.
No, that's totally fine.
Yeah. And so I think Mercedes' earlier point is you got to look at if you want the deduction, you got to look at the state, but the different plans has nothing to do with where you go to school.
Correct.
I think that what's happened in the tax code, I believe it was last year, and I've had a few of these come through my office, is we've got extra money sitting in 529 plans that we're simply not going to use. And now there's a provision where you can transfer it, that extra, to a Roth IRA. Now, here's the thing to be very careful about, and where debate has come in, at least with my client base, is that money doesn't go to a Roth for you, it's for the kid. And so if you funded the 529 plan, you might not want to do that. And where if you still need the money, but I've had many who are very legacy oriented, they have financial security and won't run out of money, and they designated it already for the kid, and they're happy to do that transfer. And so this is new. This is a really big thing. As you heard me say earlier, tax-free is the holy grail. And again, no required minimum distributions. So that's an option. Anything else you wanted to add there, Mercedes?
Yeah. So the 529 has to have been open for 15 years to qualify
Yes,
for this. And you can
exactly.
only roll over the equivalent of what a Roth contribution for that year would be. So for example, it would be 8,000 for if you're over, actually it'd be 7,500 for 2025. I'm sorry. And you can do that at the annual limit until you hit 35,000. So there are some, and that could change, that very well could change. Now, if they don't use it all and they've gotten scholarship, you can take out the money to the extent of the scholarship, not pay the 10% penalty, and only pay tax on the gain. So you do have some options for transferring that money somewhere else. And also, if you have another beneficiary, let's say grandchild A doesn't use it all, you could potentially use it for grandchild B. So there are some flexibilities with the 529 that I do really like.
Yeah, no, absolutely. And to your point, that puppy has to bake for 15 years before you begin. And I had cases where that actually was the case. And that's why
Okay.
this was like a legit strategy on the table to consider. Okay, charitable giving. The big time of year for this tends to be in November, but we're going to address it now.
Okay. So the annual gift limit is 19,000 per person. So if you are a couple and you want to give your child money, each one of you could give $19,000 to that child per year. And what that means is that if you're under that limit, you do not have to file a gift tax return, which reduces your lifetime giving limit. There's not a tax if you go over that over the 19,000, but there is a reporting requirement. Why would you want to do this? If you're about to hit the estate tax limit, which could change depending on who's in the administrative offices, you may want to start shifting some of your wealth to other people to get it out of your total estate. It is not a deduction on your tax return. A lot of people think, oh, if I give 19,000, I'm going to get to deduct it on my, no, that's not how that works. But it does remove it for future planning purposes, which is why planning is really important.
Let's level set that if we could, because I get that, like you, I get that question all the time.
Sure.
So if you're giving a grandkid, let's just say $50,000, so you're exceeding this, there's no deduction. You have to report it as a gift tax return, but the only thing it's reducing with that annual exclusion has to do with estate taxes. So what is the annual exclusion for the people in the back of the room? So we're really clear.
Let me look that up real quick.
Sounds like it's a quiz. Was it 14 million?
That's more like the estate. Okay. 13.61.
13.61 million?
Yeah.
Yeah. So if you have an estate that exceeds 13.61 million, that's when we need to worry about it. So don't get caught up on this, how much can I gift each year thing. And by the way, this is also what you hear about going into 529 plans. You're just simply, you own the 529 plan, you're doing an annual gift to it for the benefit of that kid or grandkid.
Batching donations. So for example, if you have a group of 5 different 501c3s registered in the United States only, no foreign charities, and you do that every year, but we're not quite hitting the current limits to be able to itemize, we may want to do what's called batching, which is taking 2 or 3 years and clumping them all into 1 year so that we're actually getting tax advantage of those. And then the charities will just have to budget their money accordingly, but you're getting the full tax advantage of it. The other option is if you're over 73 or in that RMD requirement, you could do what's called a charitable a qualified charitable deduction where you take the money from your RMD and you have it sent directly from the brokerage house to the charity of choice. If we're not hitting the itemized deduction limit, this is a really great way to do it because it reduces how much of your RMD you're going to get taxed on. The caveat, it has to go from broker to charity. It can't come through you. And all of the IRAs are set up to be able to do that for you. What you would want to let your tax person know is that, hey, yes, I did give 20,000 I did it through my IRA so that they're not deducting it twice. The next option is a donor advised fund. And Meredith, do you want to talk about those a little bit?
Yeah, where I see also known, because we all love a good industry acronym, they're called DAFs. We see a way where we see it a lot with clients that have company stock. It's highly appreciated. They don't want to pay the capital gains because who does? So they'll donate the stock to a donor advised fund and you'll talk about the tax deductions on that. So let's say I'm sitting on Coca-Cola stock. The capital gains are, the gain in it's over $200,000. By giving that stock to the DAF, I'm getting the deduction and I'm not having to pay the capital gains. If you'll work through the operational logistics a little bit more too on that, Mercedes.
Sure. So what happens, rather than selling the stock and paying the capital gains at either 15 or 20% long-term, if they're long-term, plus your state rate on them, you transfer the stock directly to a donor advised fund. Then you sell it within that fund and then you give to charities through that fund. So similarly to batching, doing the qualified charitable through an IRA RMD, you would take the deduction as a charitable deduction in the year that you give it to the donor advised fund, not when you're writing the checks from the donor advised fund to the charity. So you get it all in year one. There are different rules for cash versus stock. So cash is 60% of your AGI, stock is 30. So depending on what your income levels are, we need to talk about what your upper limits of giving are for that current year. But this is also a good way if you do have that stock, because we don't want to pay capital gains on highly appreciated stock. It avoids paying the gain on that, and it gives you the charitable deduction, which is a great way to mitigate some tax.
Right. And similarly, we both have clients that give to their alma maters, Go Jackets. But so you can give appreciated stock. That way you're not paying the gain. And it's a nice gift in getting the tax deduction. Okay. I'm going to speak a little bit here because, again, 90% of what I do is pure strategy. When we talk about asset location, I like to look at some things we hit on, like what is the tax implication of saving money in this kind of account now versus later. And so we're taking into consideration capital gains in those after-tax brokerage accounts, things we already touched on a little bit about Roth versus pre-tax. And quite honestly, the other thing it does is it creates flexibility later in retirement with which bucket we're pulling from. I have a case right now where we're delaying pulling money out of IRAs as long as possible because of the income tax. And I want money in that after-tax account to create a bridge to allow us to delay and wait as long as possible on the IRAs so that coordination and that strategy element is so critical. Most people I see, they've just invested and there hasn't been a lot of thought and intentionality around it. But developing that strategy that's going to come down the pike when you need to start using the money is so critical. The other side of it is how we think about it in terms of risk, which David will probably touch on a little bit. I'm of the mindset, the shorter the time you have until you need the money, the less risk you can take. If I know I'm going to never take a RMD or required minimum distribution out of the Roth, I might as well put that puppy to the limit because I'm not going to need the money. And so I can take a lot more aggressive risk allocation than I would with perhaps a 529 plan if I'm putting a kid through Auburn University and I got to write a big check each year. So that strategy, that asset location or how it's taxed and that tax diversification is really key. Anything else you want to hit on that, Mercedes?
No, I agree with all those strategies. The closer we are to retirement, the less risk we want to take, especially if we need the money and we need to
Mhm.
pull it out over a let's say 20 or 30 years post retirement. We definitely need to be careful with that.
Yep. Okay. So this is big. This is a big part of what we do. Many of our high earning W-2s have company stock. We know we get hit with a tax upon vesting. Strategically, though, it's a concentrated position. And I have a lot of clients who are like, Meredith, I work there and I have all this company stock. And God forbid something bad happens and that particular position goes down. How do we create diversification there? And so usually I'm of the mindset, as soon as it invests, I want to sell it so we don't have a capital gain embedded. And then we figure out with this proceeds, how do we diversify it? Now, if there's stock that we want to hold on to, that's where my friend David over here and I are creating plans, and he's going to hit on some of this. We need to hold certain amounts. How do we diversify around positions that we still have? So the tax is important on company stock. The second component is concentrated risk. And how do we create a transition plan over time? Similar with employee stock purchase plans, many of you that work for a big fortune company, you can buy company stock at a discount. But the same thing is true. We want to be very careful on concentration risk and making sure that we're holding, before we sell it, that we're holding it for the right period of time so that we're paying a long-term capital gain, which Mercedes already alluded to is a much lower rate than what we would characterize as a short-term capital gain, which is ordinary income tax. Capital gains is typically much, much lower than your ordinary income tax rate. Anything you want to add here, Mercedes?
The biggest thing that I see with RSUs and the tax planning is you sell to cover, meaning they withhold tax on that sale at the time that those RSUs vest. However, if your base is 350 and you're getting $1 million worth of RSUs, you're going to be in a totally different tax bracket than they may have withheld on. And so we really need to do some tax planning, look at your estimated tax situation, your overall tax situation to make sure that we don't have a huge shortfall at the end of the year, because they may have withheld at 25% and you're in, let's say, a 32 or 35, 37% tax rate. So we really have to be careful with those and making sure that we've properly accounted for all of the tax that's going to be due on that.
Not just that, but we have some usual clients, all three of us do, where it blows me away. They may have salary of 250, but they get $500,000 in company stock. And I know those are big numbers, but it creates cash flow problems because they build a lifestyle where they can't live off of their base salary. They need to figure out how to liquidate some of the stock to cover their base living expenses. So the tax optimization is really critical for those of you that are senior leaders that have a lot of company stock.
Correct.
Yeah. So let's hit on this, and we're going to get ready to lead into some of the stuff David's going to go over today. So tax efficient investing and tax loss harvesting, my favorite component. I'll let you get started with offsetting gains and stuff like that in the wash rule.
Yeah, absolutely. Thank you, Meredith. So a component of the work that we do together is not just investing to be able to grow the assets. I always like to say it's not just about what you make, it's about what you keep, which is why what Meredith does, what Mercedes does is so important. In my part, we look to invest tax efficiently by working to offset any gains and reduce that taxable income through what we call tax loss harvesting. Essentially, what this means is that we know as we build a portfolio, there are going to be stocks that go up and stocks that go down over time. If you're not doing any tax management, as Meredith is showing here on the left, you may start with $100,000 and your investment, like this past year, did really well, went up 20%. And we started with 100,000, we ended with $120,000. Unfortunately, that's a $20,000 capital gain if you sold and realized that. We end up having a $7,400 tax liability. Your ending value is $112,600. Now, we look at active tax management. Many times, folks go and they reach out to us or to Meredith or Mercedes in December and say, have you done any losses? Is there anything that you can find to help me with my tax bill? I anticipate paying some taxes this year. And if you're not doing any tax management throughout the year, likely you're going to have limited opportunities. Something that we focus on is how can we do active tax management throughout the entire year? A good example of this would be during the pandemic year of 2020. In March, we had a 20+% drop in equity markets. By the end of the year, equity markets were up over 20%. So if you started looking at your investment portfolio in December of 2020, there were no losses to take. So in this example here, if we did active tax management, we started with that same $100,000. By the end of the year, the portfolio appreciated 20,000, but we were able to do some tax loss harvesting throughout the year. We could bank a $20,000 loss in this example to offset those gains, and we end up with no tax liability and a similar ending value. Now, how does that work? That's essentially that Coca-Cola stock that Meredith mentioned. We may own Coca-Cola. Let's say they had a really bad earnings quarter. The stock dropped 10%. We would sell that stock and harvest those losses. However, we know it's important to stay invested. So we would go and buy the competitor across the street that everyone in Atlanta loves, Pepsi, and own that stock for 30 days. I know. But why would we do that? Because the IRS knows that if you just sell the stock today and buy it back tomorrow, that you're looking to generate a tax loss. So what that is a wash sale. So you have to wait 31 days to be able to buy back into that same security to be able to get that loss. So to avoid the wash sale rule, you have to buy or invest in something comparable, but not the same. And then you can buy back in after that period of time, get your Coca-Cola that you love and push Pepsi to the side and bank that loss. So it's a way to be able to, what we call generate tax alpha over time, because these losses that you can harvest are able to be utilized going forward in perpetuity unless tax laws change. So losses that you generate in 2025 could be used in 26, 27, 28, and in the future, which can help manage your tax bill for the long term.
And to be clear, and you said it, but I want to be clear because I get this question a lot. These portfolios have the same return in the investments. All we've done here, instead of just looking at the end of the year when to sell something, it's being done throughout the year. And I hear a lot of people, they're like, I assume my advisor does that, but I don't really know. And so this should be, I know November's a really key time to have this discussion to see where we're tracking because of estimating taxes for the end of the year. But this is a very important thing for those of you that have more limited deductions. So we have a question really quick. Right side shows 112,000 as ending value, should be 120. Could have a slide mistake.
Yeah.
It should be. Thank you. Thank you. Apologies. So what we hit on today, before we jump into markets, David's going to give us the tale of where we are, where we're going with markets, some high level stuff. We talked about maximizing retirement contributions, Roth IRA and conversions, tax advantaged accounts, charitable giving, asset location, and tax planning strategies for those of you that have company stock. And then finally, tax efficient investing and tax loss harvesting. So with that, let's jump into market updates. Dave?
Great. Thank you, Meredith. This conversation is coming at a great time. I'm sure as many of you are looking at your portfolios, getting prepared for tax season, you may have noticed that 2024 was a banner year for stocks. The S&P 500 in the US was up 25%, over 20% for the second year in the row. And the NASDAQ, which is more of a tech-heavy index, was up over 30%. Meredith, if you go to the next slide, we can show what was contributing to that, which is the colloquially known Magnificent Seven. So I'm sure many of you may have gotten used to ChatGPT or Claude or whatever kind of artificial intelligence was coming up during the year. Companies that were invested in this theme did very well last year. NVIDIA being the poster child for it, up over 160% last year. 7 companies contributed over half of the return of equity markets in the United States last year. However, something that we started to see emerging as we got to the tail end of last year and so far in 2025 has been market breadth. While only 7 to 10 companies have been dominating markets for the better part of 2 years, we start to see other parts of equity markets begin to perform as folks are looking for other opportunities to find value. If we go to the next slide, we've been conditioned to a market that has not had much volatility in the last couple of years. Volatility in 2023 and 2024 has been historically light. Our expectation for 2025, understanding there's some more uncertainty, geopolitically and policy related, will lead to heightened volatility in equity markets, making it more important to be very active managing your concentration risk and your tax management for your investment portfolios. We go to the next slide. On the other side of your ledger, outside of the equities, which performed quite well in the last couple of years, we experienced another challenging year for bonds in 2024. Bonds have pretty simple math. When interest rates go up, bond prices go down, and vice versa. And since 2021, interest rates have gone up and they've stayed higher for longer. We've seen that benefit in our money market accounts and in our savings accounts. We've seen it hurt on our credit card APRs and mortgage rates. So you see it on both ends. But for bond investors, the last 3 years has been a sea change from the prior 40 years where interest rates have been going down and it was easy to make money to offset the volatility of equities. And while it was another tough year for bonds, one of the areas that we focus on here is how we can invest, especially for high earning W-2s and taxable accounts, invest in high quality municipal bonds and owning these bonds outright to help mitigate some of the volatility that we would expect in 2025, which could be another tough year for bonds.
When owning, David, if you could speak to why owning the individual bond is so much better right now than owning a bond mutual fund like most people do.
It's all about control, right? And when you own a mutual fund, whether it's an equity, a stock fund, a bond fund, you are invested with a whole group of people. The 25 plus of us on the call together could all be invested in the same bond fund. And let's say I have a 6-month-old at home. I want to go and start paying for daycare. I don't want to, but I have to go and pay for daycare. I might need to take money out of that bond fund. And the bond manager is going to have to sell their most highly liquid, probably their highest quality bonds to raise capital for it. At the end of the year, there could be some capital gains from all of the trading. And whether you invested on December 1st or January 1st, you're going to experience those within the fund. Also, you're going to be privy to the ups and downs as bond prices move with interest rates. So owning individual bonds means that you can hold a bond until it matures. So prices go up, prices go down, just like your house. Unless you have to sell it, you're not locking in any gains or losses. So it allows us to plan more effectively, both for risk and then also for taxes and for income. So why did markets do well last year? Essentially, there was a recession that never came. The labor market was strong, unemployment stayed low at about 4%, and company earnings were robust. We're finishing the fourth quarter earnings season, and so far earnings have been 15% or more, which is the strongest we've seen since coming out of the pandemic. Now, this morning, we saw some reports from Walmart, and I'll get that in the next slide here because this recession didn't come because the US consumer was able to hang in there. People feel pretty good when their home prices have gone up and they look at their retirement accounts and those values have gone up as well. However, when we look at the US economy, we know that GDP, which grew over 2% last year, is driven by consumer spending. And I mentioned Walmart earlier because they came out this morning with some results that were having warnings about spending going forward into 2026. The consumer has been able to withstand inflation, and that's led to strong market performance. However, we are starting to see some upticks in delinquency rate of consumer loans, and we are watching retail sales numbers to see if the consumer can continue to spend at the clip they have. Why is the consumer hung in there? Not just seeing home price appreciation and stock market appreciation, but wage growth has outpaced inflation for the past 20 months. So people are starting to catch up from the challenges that they experienced in 2020, 2021, and 2022. But this is a very bifurcated economy. Long story short, the US has been able to continue to spend through thick and thin. but there are challenges that we are mindful of. We move to the next slide. Part of the positivity, and many of you are small business owners on this call, but small business optimism has gone up. Since the election, there has been some optimism. Much of that has been driven by some expectations for tax cuts and deregulatory policy. We can get into that in a moment. And the consumer's been feeling a bit better too, because as we said, they look at their accounts, they're doing better now than they were in the last couple of years. This has led to some enthusiasm in markets. It's where we tend to go and throw some cold water. It's great to see something like Bitcoin go over $100,000, but those are some things that when we look at markets, we see these quote unquote animal spirits that have been driving markets away from their fundamental values. So that's why we focus on diversified multi-asset class portfolios. It allows us to take advantage of some of this optimism, but also put on some cool logical thinking for our longer term planning initiatives, both for growth and then for taxes. Moving forward, I think an area many folks have been concerned about has been international markets, because let's face it, you turn on the TV or you go online and there's a news story talking about how things are not so great outside of the United States. And that led to some sell-offs at the end of last year. Now, to start 2025, international equity markets have done reasonably well. They're actually outperforming the US because many of these concerns that we've seen have been less than what actually was expected. However, we still are concerned about what will happen. Will the ceasefire hold in Gaza? Will we actually have a deal in Ukraine? And will developed economies in Europe like Germany and France stay in recession, or will they be able to move out of it? All things that we're watching as we go into 2025. Because it's been a challenging few years. While the US has been able to get out of those pandemic doldrums due to some pent-up demand, international equities have been more challenged. China is now just starting to emerge from a few challenging years, and also developed Europe has had tough times being able to grow their economies as we got out of that pandemic environment. It's been a tough 5 years. Can't believe that it's been 5 years. There are some silver linings though, and when we look around the globe, one of the areas that I focus on as a CFA charter holder is valuation. And US stocks, while they have been doing great, they are in some parts of the market overvalued or richly valued. International equities are looking quite cheap. And we know you don't just buy something because it's cheap. You want to make sure there's good value behind it. So part of what I do every day is look to see where can we find the opportunities for quality investments around the world that we can get at attractive prices. It's like all of us when we go out to the store, you want to look for a sale and you just don't want to buy something because it's on sale because it's a ratty item. If there's a quality item that is for sale, you want to snap that up and buy it. So spend a couple minutes on everyone's favorite topic, which is that this current administration, every single day, we know it's changing. We're a month into the second Trump administration. And so far, what we've seen is policy agendas that are quote unquote pro-growth. And this could be positive in the near term for US equities and for GDP. Focuses on deregulatory policies, cutting some red tape, tax cuts, which we expect the current tax cuts, the 2017 Tax Cuts and Jobs Act, to be extended as it expires at the end of this year, and additional domestic investment could be positive for US equities. We've already seen it impacting parts of the market that did not find favor in the last couple of years. I'm talking about small cap stocks and value stocks. These smaller businesses can benefit from a more favorable policy environment where taxes are lower, interest rates come down, and there's less red tape. All of that making it better to be able to form businesses and invest in and grow them. There are some concerns about inflation that we're paying attention to, because some of these policies, from tariffs to the tax cuts, which could be additional deficit spending, can lead to inflation and make it tough for the Federal Reserve to cut interest rates, as they've already started to do. So while we see some broad growth overall, US equity markets we expect to continue to run, we do see some challenges. International equities, we expect the uncertain geopolitical environment to lead to some ups and downs throughout the year. And bond yields, with rates being higher, could be challenged going forward. But it's a great entry point when we look at where rates are today. Of course, We focus more so on the taxes and deregulation. That's what this call is all about. And we don't know what the tax deals will be. We expect as we get closer to the middle of the year, we will see a larger omnibus bill being worked on that could include not only the extension of the 2017 tax cuts, but also additional treatment of taxes on tips or the SALT deduction, what have you. So there's a lot to come down the pike. We're really early innings here. Going forward, I just want to wrap up with what the market is telling us right now. And that is there is opportunity in different parts of the market that haven't participated so far. When we look at deregulation, financials, energy stocks, industrials could stand to benefit from that. If we go on further, Meredith, in the presentation here, there are areas that could trip us up. Geopolitical conflict is top of mind. Inflation coming back is another. These are areas that we're always looking at. So we look to build diversified portfolios that could weather these storms because we know that markets do correct. It's a normal part of investing. The goal is to take advantage of that in taxable accounts. That could be an opportunity to do some tax loss harvesting, for instance. Something that we're looking at too, when we look at inflation, why we mentioned it might be a normal occurrence for it to come back is on that chart on the left is showing CPI in the 1970s through 1980s. We had something very similar back then to what we're experiencing today, which was a first wave of inflation, a come down, and then a second wave. The Fed's job is to try to mitigate that risk for a second leg of inflation, but that's something that we are very keenly aware of that could trip us up in 2025 into 2026. However, this bull market should continue to run. Our expectations are that businesses are in good shape. They have significant assets. Earnings are strong. And the consumer, while retail sales, as evidenced by Walmart this morning, may start to see some challenges, overall, the U.S. consumer is in pretty good shape. So when we look at just wrapping up our thoughts on this, bull market still has legs. And going forward to our final closing, we do think that this bull market does have room to run. However, not without some corrections. At the end of the day, every year you tend to see a 10% plus dip in markets. That's healthy. We haven't seen it in a little bit. What gives us some optimism is that there's $7 trillion sitting in cash on the sidelines right now. As interest rates do come down, that money's going to look for a place to go. And we'll continue to see this adoption of artificial intelligence, which could lead to enhanced productivity and growth. We expect other parts of the market like small cap stocks and mid cap stocks and value stocks to catch a bid, especially if some of these trends continue. And overall, our theme for this year is that we would expect 2 to 3% growth through GDP, 0 recessions, 2 to 3% inflation rate, and about 4% in unemployment. Of course, we all know there's shocks to the system that could occur, but if things move on forward, we expect that not 20% returns in equity markets this year, but solid growth going forward.
Great. Thank you on that, David. I know we're pushing time. Thank you all for taking time. I've built a very specific checklist for those of you that get a W-2 on ways to create some tax savings. I know we've got a question, which I'm going to address in a second. So feel free to grab these QR codes while I grab this question. Okay. Thank you. Great job. If anybody has questions, you can get in touch with us, both of us, and we'll send out this link if you want to watch it again or listen to it online after. And I'm ready to take any other questions that we might have. Feel free to ask. Feel free to email us after. Feel free to send a passenger pigeon. We're available to answer any and all questions on tax and markets. And again, your time is your biggest asset. So thank you, everybody, for taking the time to come out today. And we appreciate you. And we look to hearing from many of you with any questions and things that you might want to chat about.
Thank you, everybody.
Thank you.